Hi, in this video you'll be getting an objective data-based summary of the Spinneys IPO. I went through the 249-page prospectus twice, so you don't have to. You can skip the headache and focus on what truly matters if this is the right investment for you. My name is Ayo. I've been stumbling through the investment world since 2014. I made almost every mistake you can imagine, but somehow managed to luck my way out to 10 years of positive returns. I don't have anything to sell you. I'm just sharing my analysis because I don't day trade. I buy good assets and hold for the long term. So I'm very selective about what I buy. The scope of this video, I'm going to be focusing on the stock, the financials, company overview, future outlook, a little bit of IPO details, and my final recommendations. You can skip to the recommendations if that's what you're here for. Some things I will not be covering is the basics of stock market, finances, IPO, actual technical to-dos like how do you buy the stock, how do you create an investor number, so there's a lot of tutorials for these things, so I will not be covering it in this video. We'll start with the company overview. Spinneys is a chain of premium grocery retail supermarkets under 3 brands: Spinneys, Waitrose, and Alfair. They mainly operate in the UAE, but they have 3 to 5 stores in Oman, which have been unprofitable, at least for the last 3 years, which is the only time frame I have disclosed audited financial statements from. But we'll talk about that in the financial section. The group actually started in Egypt in 1961 with 1 store, and then expanded and then to UAE. Since 1999, it's been owned by Al Buardi Investment, which is a UAE-based holding company founded in the mid-70s, which boasts an annual turnover more than $1 billion, which is pretty significant. They own the 3 brands under Spinneys, as well as dozens of hotels and industry companies and a lot of things. It's a huge, huge company, which is good generally in these kind of things. Over the last 4 years, so the group now has, going back to Spinneys, the group has now 75 stores, 64 out of which they operate and manage and own themselves, and another 11 which is only operated by the group but owned by someone else. Now talking about the evolution of the stores, for a brand that's been there for 60 years, having almost 1 store per year is not an impressive growth trajectory. And we'll talk more about the financials and how those have been growing, but it follows a similar trend, very slow. In the last 4 years, 31 stores were added, but 24 stores were closed. So there was a net gain of stores, but I'm left wondering and having a lot of questions about why would you open 31 stores and close 24? And there isn't a lot of information on that in the prospectus. Next, we'll talk about the brand strength. So I think the brand is the biggest competitive advantage they have. There are many other premium grocery outlets in the UAE. I think Spinneys, because of their history, have a very strong brand. In fact, 87% of people in the UAE have been able to identify the brand in a survey. And in the Saudi, which is a market they're trying to expand into, that number is a lot lower, but it's still decent at 30%, 30. Unfortunately, most of the revenues of this company comes from the UAE side. In fact, they only operate in the UAE. They do have, this does pose a risk. The Omani segment is losing money, which is probably why the company is actively pursuing to diversify into Saudi to mitigate some risks associated. They also entered brand agreements, which is some sort of franchise agreements with companies in Lebanon and Egypt. There are not, they have not disclosed any details on that, but that will not be very relevant to this analysis. Moving to online sales. Online sales is one of the biggest red flags for me personally in terms of not investing in this company, because their online penetration is 13%. So only 13% of their revenue comes from online sales, which is not enough. In this day and age, this is not enough. And 13 could be good if the year before that it was 0, and the year after that it goes up to 18 or 20. But there isn't even one page talking about their online strategies, how they plan to expand it, or anything relevant to that. So it's clearly not a priority for the management team, which is a red flag. To be fair, they do boast a 94.7 on-time delivery metric for all of 2023, which means 94.7 claimed deliveries have been arriving on time. But I would question that number also from my time at Amazon, because on-time delivery can be measured in many different ways. And to get a 94.7 metric, probably they are measuring it based on the first contact with the customer. So as long as they try to reach the customer and the customer doesn't answer, they consider it a successful delivery. That's what I think. There aren't enough details about it, but anyway, that's not too important right now. We'll go into market share, the next big piece of the puzzle. So the group targets households earning over 20,000 dirhams per month, which is what they consider an affluent population, and that's good because the target market in the UAE is projected to grow at about a 4.4% year over year over the next few years, which is slightly better than the grocery market, which grows at 4%. Basically, there is going to be a bit more rich people than there are people over the next few years. The Saudi has much more impressive metrics, around 6.7% for the affluent population, whereas the normal population is only growing at 4.8%. Decent. And here we can talk about the customers of Spinneys. They're mostly expat Westerners at more than 36%, expat Asians, expat Arabs, and Emiratis. Basically people with a bit more money to spend and looking for that premium experience, and they tend to spend more per average in Spinneys than in other supermarkets, and they are more affluent. So the Spinneys demographic is better than a typical demographic for a supermarket, which is great. They claim that they have 12% of the target market share in UAE and 27% in Dubai. So 27% of people earning more than 20,000 dirhams a month shop at Spinneys. These surveys are based on a consulting company that they mentioned here. I could not get the originals to validate, but we can assume they're pretty accurate. Continuing, we will talk about now the brand license, or another, I would say, competitive advantage they have. How much of an advantage that is? Not very big of an advantage. So there's two things. There's the actual brands associated with Spinneys, which are these three, Spinneys, Waitrose, and Al Fair, which gets renewed every 10 years. So they have those brands till 2029 for Spinneys and 2031 for Waitrose. But there's a very weird situation there where they're not able to get in touch with the original company owning the brand. So the check from the last payment has not been cashed yet. This is for real. So this is what I'm talking about. GML, which was the owner of that Gray McKinsey Holdings, the owner of the brand, has been removed from the register in 2021. And since then, Spinneys has not been able to connect with them. The annual fee check has not been cashed. The license was granted in 99 and can be renewed for successive 10 terms, which is currently renewed till 2029. So I don't know what complication that creates, maybe it's not a big deal because that company may have been dissolved, but it's a very strange story. The other part of their competitive advantage is the exclusive right to sell some brands in the UAE, such as Heineken Zero, which is the alcohol-free version of Heineken, and this random brand I've never heard of. The margins are super healthy on these kind of brands, and the revenues have been growing. So this is 94.9 million. It's not bad. Is it enough of a competitive advantage against other retailers? Not really. In a market that has so many different options, unless you have a major licensing exclusive deal such as like Coca-Cola, then it's not such a big advantage. It's just an additional source of income. Next, we'll talk about the holding company ties. So there's a lot of ties to the holding company, which is Al Bawardi Investment, officially disclosed at Al Group in the prospectus. Yeah, so there's a lot of ties to the holding companies, and that shows up here and liabilities, where out of the 45, there's 45 million on their finances that's due to other parties, and out of that more than 30 million is due to the holding company, and that includes maintenance contracts, some kind of operational contracts and logistics. So a lot of the reliance of Spinneys, or a lot of the business and the support system for Spinneys, is actually its holding company, which could be good, but also means that they're not seeking out more competitive contracts, they're not changing their suppliers. It does give them more stability, but it does also increase their cost structure. So I'm not sure how I feel about that. Moving to the employees. Their workforce seems to be very happy where they are. 22% of employees have a tenure of more than 10 years, and the average leadership tenure is 23 years. This shows stability. It shows that it's a good workplace. It's not a toxic environment. And stability does lead to more consistent operations, smooth operations, simple, fast, smooth, which eventually translates into less disruptions, less problems, less turnover, less unhappy customers, less costs for recruitment, and so forth. So this is a very good thing for a company. That now, as it pertains to the management, as it comes to management, they do boast that they have 25, 18, so many years of professional experience. True, but there's 0 years of experience managing a publicly traded company. And experience is just numbers, right? Like, what have they actually done? Have they been able to take a local brand and make it a multinational, international brand? Have they been able to double profits? What have they been able to do? I don't know. Their management team seems to be well educated. Their CEO, Sunil, their CFO, Mukesh, was working in Ernst & Young. Their deputy CEO was working for them for more than 20 years. The operations GM has been with them and with Waitrose for a while. The management is fine, I think, but the most important person out of all of these is Mr. Sunil Kumar, the CEO. And I think, credentials aside, when you're talking about investing in a company and a company going public, the CEO can make or break it, basically. A bad business with a good CEO will eventually be a good business, and the reverse is also true. So I've watched this interview with Bloomberg, which was not too long ago. It was posted 1 day ago. And honestly, I was not a big fan, but watching this made me confirm this is not a company I want to invest in. I don't feel he actually has any ambitious plans for the company. When he talks, he doesn't reference data. He does not talk about very accurate or very specific targets. He throws on a lot of jargon, like vertical integration, and he keeps talking about how they've been around for 63 years and there's great demand for the product. If your biggest selling point is that others are buying your product, you either don't understand the business or you don't really have a good way of marketing yourself. So I was not inspired. I feel like from my time at Amazon, I can pull up at least 5 people off my LinkedIn that can at least give a better interview or be more prepared for an interview, or your company is going public trying to raise $375 million. And to be honest, it's not that he was not unprepared. It's just that it wasn't convincing. This is not someone that is gonna double your business or expand into new things. It's not someone who has big visions. It's probably someone who's executing on the vision of the owner, which is the guy behind Al Buardi investment, which is the person who effectively controls Spinneys. There's also this video that Spinneys posted celebrating 60 years in business, and I've watched that also to get an understanding of the culture of the company. And there's some quotes from the director, so that's a level above the CEO, which is effectively the real direction of the company and where it comes from. And you can watch this, but basically what he says is, I have it written here somewhere. The director says, I had the chance to be the biggest retailer in the Middle East before anybody, and I refused it, and I decided to be the best retailer in the Middle East. Okay, and then we've been there for 60 years, so we must be doing something good, and we plan to stay another 60 years. Okay, sounds nice. I appreciate that you want to be the best retailer, and if my brother or sister are looking for a job, I feel Spinneys would be a good place for them to work, because it seems like a positive environment. There aren't a lot of, aggressively capitalistic targets. But we are in the stock market, and the goal here is to maximize returns. And I'm looking for the best CEO and the best leadership that can ambitiously expand the business, get new profit channels, expand into new territories, be ambitious. I want someone who wants to become the biggest retailer in the Middle East. So while I do appreciate the positive sentiment of his message, it actually does not work in his favor when you're trying to raise $400 million to expand and to sell a quarter of your company. Secondly, same thing about the marketing. If I ask you, if you're in an interview and someone says, hey, why should we hire you? And then your response is, hey, there's 4 other companies that hired me, so I must be doing something good. That may be true, but it's not a good reflection of your understanding of your own skills and talents. And similarly here, if your biggest selling point for your company in their 60th anniversary is to say that we must be doing something good, we've been here for 60 years, then I wonder if you really understand and can communicate and can market your biggest competitive advantage, which, as someone who's been analyzing this company for a few days, I can tell you they don't have big competitive advantages. They do have some brand trademark deals which will expire, which can be renewed, which is fine. Their brand is good. I'm not saying it's bad. In the UAE, the Spinneys brand is good, but it's not enough. It's not enough of a competitive advantage. Okay, having gone through the company overview, we'll talk about the future outlook. Very easy to do that because there aren't many ambitious plans. They plan to open 1 store in Saudi and 3 stores in Dubai, which is about a 5 to 6% increase in number of stores in a year. And in one interview, the CEO, actually it's the same Bloomberg interview, the CEO mentions that their plan is to open 25 stores in the next 10 years in Saudi. Now this is not disclosed in their officially binding prospectus, which is the more legal document. This is just something that was said in an interview, so I'm just gonna delete this off my notes, because as far as I'm concerned, this is just an ambitious what if, or ambitious hope so. Anyway, that's the future outlook. We'll go talk about the IPO details now. This is going to be the first listing of a UAE supermarket chain, which is expected to raise $375 million, which is about 1.4 billion dirhams, for 25% of the shares, which will give the company a market cap of about 18 to 20 billion dirhams. Decent. But the one I'm really looking forward to is Lulu Hypermarket, which is going to be rumored to raise 2 billion, so about 8 times as much money. That's coming at some point this year. I'm looking forward to analyze that one and hopefully invest in it after seeing the financials. More about the IPO, they're offering 900 million shares. The subscription period is going to be on the Dubai financial market, periods from 23rd to 29th, and then it'll start trading 10 days after the subscription ends, which is in line with the other IPOs that happened this year, both in Abu Dhabi and Dubai. Interesting thing to note is 20% of the IPO has already been pre-committed by 2 investment firms. One of them is an Abu Dhabi-based holding company, and the other is an American investment firm. So together, they're going to buy 20% of the shares offered. So 20% of the 25% of the company. Good for them. I guess they must have seen something which I don't, or they must have some connections to the company. I have not investigated them in detail, but it's worth noting. Generally a good thing when you have companies committed to purchasing parts of the IPO. It reduces the risk by basically 20%, because 20% of the shares are already gone. Moving to the meat of this, the financial health. So I've reanalyzed everything from their financial statements. They've only disclosed 3 years of audited financial statements, 21, 22, and 23. And I can tell you that the revenue growth over the last 2 years has been 4% and 9%, so an average of 6.7%, which is this number here, 6.7%. Their net profits have grown about 8% over the last 2 years. Cool. Other highlights, their other income, which is unclear where this is coming from, has increased by 33%. I don't think this is the online sales, but they don't mention where this is coming from, but this would be a good thing to, market a little bit more or explain. Their marketing costs have increased a lot, which is logical because they have an IPO coming and they've been posting about it on their socials, and it's completely normal. A lot of their costs have risen. Obviously, the cost of the IPO is a huge increase in their legal and professional charges. One thing that's not very clear to me is how their net assets have increased. They must have acquired something 2022 to 23, because their properties and plants have increased almost double, 172%. But overall, their total assets have been growing at the same rate as their revenue, same rate as their profits, about 6 to 10%. So if you're looking for, and guess what, their liabilities are also growing at about the same rate. So this company is stable, I can tell you that much. It's not going to get you rich, and it's not probably going to zero. It's going to stay there for a while. But a few things also to keep in mind is they do have significant liabilities because of their leases. So out of the 64 stores they own, 62 are leased. They don't own the land, which could by itself, I mean, if I'm in the market for 60 years, I'm going to try to own every single piece of land my stores are on, which is similar to the business model McDonald's employed, and the real estate that McDonald's owns, it actually gets leased to the people running the franchise. So not only is McDonald's getting a cut of the franchise profits or revenue, they're also leasing them the whole real estate. But crazy smart business model. So if I had 60 stores in the UAE, if time is on your side, you would try to acquire with such a big company and such a big, they have millions of financial guarantees in the bank. You can easily get mortgages instead of leasing your stores and make these 60 stores into assets instead of liabilities. Really good thing they have is new stores typically have a payback period of less than 3 years, which makes me, this is amazing. Any business that has a payback period of 3 years is amazing. If I give you $100, you're going to give me back 200 in 3 years, that's a good deal. That's almost an ROI of 30 to 40%. But if you have such a good business model, why aren't you aggressively expanding it? Why aren't you aggressive on franchising it? Why are you so slow? Which again points out to the leadership, the management, the strategy, and makes me not want to be an owner in this company and not want to buy stocks. Dividends are something they do very well. They do pay, I think it was 70% of their profits are committed to be paid as dividends at the end of the year. And if you look at the last 3 years, you'll notice that they paid almost 2% more than they made. So their profits, for example, for this year was 192, which is 2021, and then when you go to the dividends, they paid 197. So it's 102%. I don't know how they're distributing more profits than they're actually making by 2%, 2.6%, 2.07%, and this one is fine. They distributed less than they made. So confirm, yeah, they made 254,000 net profits, and they distributed 197. So this makes sense, which is 77.7% for the last year. And moving forward after the IPO, they're committing to about 70% profit distribution, which is great. So which is going to make this a dividend stock, which is kind of like the only good thing about it. You can expect some good dividends. So I did a quick calculation for the dividend yield, assuming the 2023 profits and revenues, and assuming they get the share price they're asking for, and the market capitalization of 18 billion, which is the lower end, we're talking about a dividend yield of 1 to 2%, which is not very significant. If my calculations are right, this is a very low yield. For comparison, Amar for this year was at like 6%, Air Arabia was also about 6%, and if you're going for a if you're not, see, you either go for growth, a company that's growing and appreciating, or you go for something that's paying dividends. But this is neither growing or giving a lot of dividends. So I don't know why you would buy this. Maybe I'm wrong, I don't know. Thanks for making it to the end of my video. My recommendation is not to buy this for the factors disclosed, which is very weak growth over the last 3 years, uninspiring leadership, low dividend payouts, and over-reliance on the UAE market, and the lack of a distinctive competitive advantage, as well as a high amount of liabilities and no plans to increase their online penetration, no serious plans to improve their online offerings. Hope you found this useful. I'll be responding to the first 20 comments at the very least. So make sure you drop a comment if you have any question, or if you find any mistakes in my analysis. I would love to hear them so I can get better. And if you want to find out any more info, I've been looking at this IPO in detail for a few years, so I'm very familiar with it. So feel free to ask. Thanks for tuning in, and subscribe for more.